Hello, my name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your daily technical analysis of foreign exchange markets. I'll start with the euro against the dollar. The market continues to give me a headache. There are still two core patterns here currently in operation. I've highlighted the relevant trend lines in blue to help visualize what is going on. We have a possible September to date ascending triangle, currently 97.95 to 99.61, and a possible September to date bull channel, currently 97.86 to 101.40. The bull channel could actually be a rising wedge pattern instead, but that is not really the point here. The real issue is both patterns have had false breaks within the last 2 weeks. There was a false break above the upper trend line of the ascending triangle 2 weeks ago, that turned into a pipe top, and a false break below the lower trend line for both late last week. That turned back up last Friday and ended up closing on the upper trend line of the ascending triangle of all places. This was followed through higher yesterday, but stalled at the very next resistance, the declining medium moving average, currently at 10035. Now you can see why this market is giving me a headache. Both patterns have been compromised. Both repaired themselves, are now breaching again, but not forcibly. We are still here sitting and waiting to see which will dominate. It is this point that I start wondering if both these patterns are correct. Schrodinger's cat, for those who know the analogy. In the bigger picture, part of me still hasn't fully released the idea that the broken lower time, currently at 97.90, the big old broken January to May 2021 bearish Andrews picture, well, that may still be influencing the market. Now, so far today, a reactionary move lower, down from the medium moving average, but not venturing below the upper trend line of the ascending triangle pattern. If we stay here, then we could look at yesterday and today's action as a possible 2-day tweezer top pattern. Cable. A second market that is giving me a headache. Much as in euro dollar, there are two core patterns here, currently in operation. I've highlighted the relevant trend lines in blue to help visualize what is going on. We have a possible late September to date ascending triangle, currently 112.87 to 115.04, and also a possible September to date ascending wedge pattern, currently 112.68 to 117.30. The issue here is that both patterns have had false breaks within the last 2 weeks. False break above the upper trend line of the ascending triangle 2 weeks ago, failed at the upper trend line of the ascending wedge pattern, and just short of the declining medium moving average, currently at 116.71. Meanwhile, late last week, we had a contrary false break below the lower trend line for both patterns that turned back up last Friday and ended up closing right on the declining short medium moving average, currently 113.59. An associated vestige of the old broken June to August bearish Andrews picture, which is still haven't really let go of. So both patterns have been compromised and both have repaired themselves, then breached again, and we are here still sitting and waiting to see which will dominate. Now you can see why I still have a headache here. Then, much like euro dollar, I start wondering if both these patterns are correct. Schrodinger's cat again, for those who know the analogy in the bigger picture. Now so far today, a dip back below the flat upper trend line of the ascending triangle, but halting at the next support, the old flash crash low from October 2016 at 114.5. If we stay here, and then today and yesterday could end up looking like a 2-day tweezer top pattern. Euro sterling. After last week's weekly key reversal up, if only just, yesterday produced a combined daily key reversal down and bearish engulfing pattern. Prices dropped down below the April 2021 high at 87.19, as well as the rising short medium moving average, currently at 87.02, but ended up closing right on the short medium moving average. The top of yesterday's action was at some recent congestion from early October between 87.69 and 87.80. And looking below, we have the April 2020 low at 86.69 as a potential support, and then the breached but possibly repaired lower time, currently 86.63, of the bullish April to August Andrews pitchfork. As a point of note, it was not the lower time that repaired that break below that was made last week and the week before, but the slightly rising medium moving average that was actually below the time at the time, currently at 8,600. Now, so far today, a seeming small consolidation, even a reactionary attempt back up, but sort of not really pushing over the April 2021 high. US dollar against the Indian rupee. A third bearish black crow yesterday. This time it was also an inverted hammer pattern. Now, inverted hammer patterns are interesting. You see, traditionally, they're seen as a bullish reversal pattern. However, data indicates that something like 6 to 7 times out of 10, they act as bearish continuation patterns. Thus, it will be interesting to see if the market will follow tradition or the data. This now brings me to a far bigger point. I previously highlighted how we have here a September to date ascending expanding wedge pattern, currently 83.04 to 85.42. Late last week, prices had pushed down through the lower trend line, and the action since then has confirmed the pattern. Thus, we have a primary target X in the 80.90 zone and a secondary harder to reach target X1 in the 80.28 zone. This may be all well and good, but we have now some light Fibonacci based support at 81.63 with some recent congestion a little lower between 81.45 and 81.50, and then we start running into things, notably the rising short medium moving average, currently 81.22, and perhaps more importantly the recent 50% Fibonacci line at 81.13. So far today, seeming follow-on lower to the data-driven inverted hammer pattern from yesterday, slipping below the lesser Fibonacci line at 81.63, but not venturing down to test the congestion, well, sort of venturing down, but not really testing the congestion between 81.45 to 81.50. Not as yet. US dollar against the Brazilian real. An immediate countering bullish engulfing pattern yesterday, if only just, reacting as it did following last Friday's bearish opening black Mariboso. This was also after last week's weekly key reversal down. Now, following the recent convincing series of moves below and out of the late May to late August bullish shift pitchfork, I've decided to retire this pattern. Instead, I've drawn a new pattern, July to late September bearish shift pitchfork, which seems to be a better fit for the recent action. Thus, yesterday's action saw prices close just over the declining middle time, currently at 514.80. This was not the only interesting level the market closed over, as it also reverted and closed back up over the 38.2% Fibonacci on the June 2019 to May 2020 move at 510.87, as well as the now flatlining long moving average, currently at 509.83. Yesterday I had a suspicion that the action last Friday may just have been a seminal moment. Well, today I'm not so sure now, but I will credit what happened then as being the reason I changed from a bullish pitchfork to a bearish one. US dollar against the Mexican peso. Well, once again, it's not like I didn't warn you that such a thing might happen. The crossover of times 2 weeks ago, highlighted by the red circle on my daily chart, specifically the upper time, currently 69.36 of the March to July bearish Andrews pitchfork, and the middle time, currently 19.78.13 of the bearish shift pitchfork for the same move, well, the crossover triggered a fresh burst of bearish pressure and moving prices below the middle time, the April 2022 low at 1971.68 and the 2021 low at 1953.63. This has led to yesterday's action being the lowest close since March 2020 and the second lowest low this year. The action also seems to have repaired the damage inflicted upon the upper time in late September and throughout October, which is quite a large feat. This now puts the 2022 low at 1940.70 into the frame, and even the March 2022 low at 1915.03, as it seems to be little in the way below right now, bar these two. So far today, a seeming consolidation, but at yesterday's low. I suspect the market may be summing up some courage and energy to tackle the late March low. Thank you for listening. This short version broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.